Hey guys, Stockaholics, thank you guys for being here today. We are likely in the early stages of a decade-long or so oil bull market. If you've been following the oil price the last several months, it has been nuts. It's gone from 100 to 130. I think today we're trading back down at 95 bucks, and it's been very volatile the whole way. Lately, there's a lot of fear surrounding the topic of recession. A buddy of mine says the oil trade's done. It's time to get out. The oil price is going down to 50 bucks. He might be right in the short term. I have no idea, but I know in the long term that that kind of an oil price is likely unsustainable and that the oil price is likely to stay higher for longer. And the way I wanted to show you guys that is by showing you guys a bunch of charts. I'll be showing four from an article written by this gentleman, the Crude Chronicles. His article actually has 8 charts, so if you'd like, go and check the rest of those charts out in that article. I'll put a link somewhere below. And follow this guy on Twitter. He does amazing work. First chart I wanted to start with, I think, is the most important. This is the International Oil Company Reconstructed CapEx year-over-year percent 5-year moving average. This chart goes back to 1923, and it's reconstructed using the financial histories of Exxon Mobil, Chevron, BP, Royal Dutch Shell, Total, and Conoco, Phillips, and all of their acquired companies. Basically, what we're looking at in this chart is these international oil supermajors and how much money they put back into their business in order to increase production over time. When you see that there is low capex spend for a certain period of time, that tends to lead to periods of times where there is high capex spend. That's because low oil price tends to make these guys not invest much in their business, and then high oil price tends to do the opposite, where high sustained oil price allows these guys to go out and increase their production. Right now, we are in the longest sustained negative period of capex spend for these international oil companies, right? So when I look at this chart, I mean, I just don't understand how you could be anything other than bullish on oil. Now, I would say that this chart is only a fraction of all overall oil production out there, right? We can't really see every oil company's capex spend or every country's, if they have a national oil company's capex spend. But I'd imagine that a lot of their capex spend would look very similar to this chart, simply because oil price is what drives the investment in any of these kinds of businesses. And I think that there's evidence that kind of supports that too. If we're looking at a lot of these OPEC countries, lately when we had these high oil prices, 100, 130 bucks, a lot of these countries, the oil exporters, they weren't able to meet their quotas, which tells you that they're probably underinvested in also. This is a chart of crude oil divided by the S&P 500 on log scale. Oil goes through these long cycles, about 25, 30 years. 12 and a half, 15 of those, oil tends to be in a bull market. 12 and a half, 15 tends to go into a bear market. And so what this chart is basically showing us is that over these really long periods of time, there are certain periods when it's a good idea to start getting into oil. If you see, based on this indicator, that you're below this line, tells you that oil is relatively cheap. And if you see that oil is above this line or nearing that line, it tells you that oil is starting to get overvalued and that you might want to start thinking about exiting your oil positions. Right now, we are towards the middle of this channel, and we've just gone into one of these areas below the line, right? And so again, these cycles tend to last 12 and a half, 15 years where they go into a bull market. So based on this chart, it seems likely to me that, yeah, we're still very early in this cycle and there's still a lot of room to run. Oh, one other thing, this chart was made a few months ago, and I know oil price is much lower than it was then. So you might even imagine we might be somewhere down here on this chart still. Again, long-term cycles. Next chart we're looking at, this is money supply growth and oil prices. I know it might seem like there's a lot going on with this chart, but one of the things you notice historically that really kicks off a oil bull market, or when it goes from a bear to a bull market, one of the things that always precedes it is a period of monetary debasement. Recently, we had the medical event in which there was about 30% more M2 or dollars created in the United States, which is the global reserve currency. And as a result, we've also seen that oil price, among some other reasons, has gone up tremendously compared to the time previously. If you listen to a channel called Finding Value Finance, he has a thesis largely based on the US housing market, and I agree with, by the way. Basically, as the US housing market goes into periods of expansion, that correlates with increased dollar creation because we have a monetary system based on loans. So when a bank goes and gives a loan to somebody on a newly created house, that creates new dollars into the system. And this is largely based on demographics. So in the 70s, you can see that that was the driver of that. This was the US housing market and the boomers taking out a bunch of loans and creating a bunch of new money into the system. And then afterwards, that demographic went away. You went into a period of disinflation. In this period, 2000s, you had the Gen Xers getting into the housing market in the United States. That led to more monetary creation. And now, along with this debasement where we had with the medical event, we also have the millennials entering the US housing market as well. So it seems based on this thesis, this idea, we're very likely to have, again, a period of increasing money supply growth. And again, that correlates highly to periods where oil does tremendously. Okay, this last chart we're looking at, this is the inflation adjusted crude oil price. That's this orange line going back to 1900. And then this is a large sample size of a bunch of different companies that are publicly listed and the number of stock splits they've done over time as well. So what you'll notice is when this orange line, the crude oil price tends to be relatively high, you tend to see periods where there is excessive amounts of stock splitting going on in a lot of these public companies. Reason for that is because the share price of the companies tends to go up dramatically during these times. And in order to make their company more accessible to the average Joe and Jane, what a lot of these oil companies do is they split their stock. And they, it might go from $500 to $100 a share. And the logic being, it's just easier for the average person to go out and buy a small number of shares in that company, right? What this tends to tell you, though, is that when this happens, there usually tends to be very high sentiment in the space. So if you're seeing that there's a lot of stock splits happening, that can be a red flag to tell you, okay, it's probably time to start thinking about getting out. And so since that last cycle from 2008 and downwards, we've seen that there's very low stock splits happening. Sentiment has been very poor in the oil space overall. And even though the oil price has gone up over the last year or so to about $100, we've still seen no stock splits so far. So this indicator is telling us that we're still very early in an oil cycle. One last thing, these were just my interpretations of these graphs that I found from the Crude Chronicles. He may not necessarily agree with my opinions. Don't take my word to kind of imply what he may think. And again, I highly recommend you guys go check him out. Anyway, curious what you guys think. Let me know what you think in the comments below. Have a great day.